This is Gerardo Del Real with Resource Stock Digest. Joining me today for an overdue catch-up is the president and CEO of Uranium Royalty Corp, Mr. Scott Melbye. Scott, it is great to have you back on. It's been a bit. How are you, sir?
Gerardo, it's always a pleasure to be on with you, and especially right now to talk about uranium and nuclear power.
Well, let's start there. I want to talk URC in a second. I want to talk about the balance sheet. I want to talk about the first mover advantage, the unique business model, and the really spectacular opportunity as we go into what I think is going to be a pretty historic uranium bull market. But before we do that, I want to talk about what I think is going to be that historic uranium bull market. What are your thoughts on uranium as a commodity, and what are your thoughts on what comes next, given the fundamentals and where everything stands today?
Yeah, listen, I don't think there's a better positioned commodity, to invest in the world today than uranium, and for so many reasons. I just have come back from London, where I was at the World Nuclear Association meetings over there, where the entire global industry meets. The level of optimism and real concrete steps being taken to grow this industry. I mean, in terms of the forecast of nuclear growth, the existing reactors and those reactors that are being completed and being built, we're on track to essentially double nuclear generation by 2050, which means a doubling of uranium demand. But we've also set out at COP28 and other forums, we've set out as an industry to triple nuclear power generation by that time. So that's an aspirational goal that might have sounded like a stretch when it was presented, but I'm actually seeing us, on track to double. But we do need to do a lot of things on the permitting and licensing and construction of reactors, but also on the fuel cycle in terms of building the next generation of uranium mines, conversion facilities, enrichment plants that'll support that kind of growth. And so, obviously demand side is great. Production of uranium is at a deficit to current demand, which we've been in that position for many years. We've talked about the structural deficit, which, in the past really wasn't as critical because we had such extensive inventories and secondary supplies. So, the gap was being met and moderated by the inventories. Well, in recent years, with production discipline and speculative buying from outfits like Sprott Physical Uranium Trust, Yellowcake, and others, we've effectively drawn down the excess inventories, effectively down to zero. It doesn't mean we have zero inventories, but there's more or less zero excess inventories overhanging the market now. We need production. And as you know, production doesn't, you don't flick a switch and bring on a mine overnight. So, we have seen kind of the lower hanging fruit kind of moving forward. Uranium mines in the United States, which interestingly were, licensed, permitted, in some cases constructed. They've been some of the earlier movers. We've seen a mine in Australia move forward, a mine in Namibia move forward. We probably need 5 or 6 more new mines starting up and producing between now and 2030. And if they're not permitted, licensed, or built, or some of them require significant capital, we're in a bit of a supply squeeze that, I don't think any nuclear plants are going to go without fuel, but I do think that utilities that were more strategic and kind of locked down their supplies earlier in this phase are going to do a lot better than utilities that are coming to their contracting and procurement later to the game. And not to mention, we have new entrants as well coming into the market. So very exciting fundamentals. We need a lot of new uranium mines, and they'll need a lot of capital investment, which is where URC is positioned to be a capital provider for that growth.
Let's talk URC. Let's talk the unique business model, and let's talk about that balance sheet advantage that I think is going to be critical here to take advantage of the most profitable part of the cycle, which I think is coming. Tell me about URC and the business model for those that may not be familiar with it.
Yeah, if you recall, when we launched URC, we kind of modeled the company on the successful Franco-Nevada Wheaton Precious base and precious metals royalty and streaming model, we were still coming out of a pretty depressed uranium market, but that was also a huge opportunity for us to load up our inaugural portfolio with a lot of royalty and streaming assets, which at the time were not in production, but they were all acquired at less than 0.3p to NAV. So where we're at now is, with mines restarting and ramping back up their production, we have a number of our assets in our portfolio that are now cash producing and cash flowing or on the verge of cash flowing. So the portfolio is crystallizing into value, but it also, we're a capital provider for new mine developments in competition with debt and equity. So we have a number of conversations and indicative offers and discussions underway with miners and developers to be part of their capital stack in the restart or startup of their operations. So really great timing. The existing portfolio is beginning to generate the cash flow we were expecting and will expect, and then lots of new business opportunities to grow the portfolio bigger, which is a common trait of these royalty and streaming companies. They're really a growth platform.
When you look at the portfolio and you look at the combination of actually having, physical uranium in there and having streams and having royalties, how do you prioritize the portfolio? How do you approach it moving forward into this next leg up?
Yeah, well, listen, it was no secret that when our mines in our portfolio were not in production, we wanted to incentivize and reward our early investors. So we deployed our cash at the time into physical uranium, really off the bottom of the cycle. We bought a lot of $20, $30, $40 uranium. Even today, we sit with about 2.7 million pounds of inventory at a cost basis of under $60 per pound. So that made sense in that phase, and it's created a bit of a war chest for us. We have over 300 million in cash and liquid assets, mainly those physical uranium investments. That's our war chest to turn to cash to buy royalties and streams. And so over time, I think you'll see less focus on physical uranium, other than, we will have streams that kick off physical uranium for our benefit. But I think you'll see us turning physical uranium into cash to invest in royalties and streams going forward. And we, like I said, we are seeing a very target-rich environment right now, in Africa, Australia, U.S., Canada, where a lot of new mines are needed. And hopefully we can be a capital provider to some of those successful startups.
Well, it sounds like you and I will have plenty to chat about here in the coming months and years. Again, I think URC is one of the best positioned uranium companies for this next leg higher. Scott, thank you for your time. Anything to add to that?
No, just, in terms of the existing portfolio, we've got, MacArthur River, Cigar Lake, the Lance mine in Wyoming starting up later this year, and Langer Heinrich has already restarted, and we're beginning to see cash flow payments. So expect about $10 million in annual revenue within 3 years, $20 million by the end of this decade, and by 2033, we should be at about $50 million annually in revenue just from the existing portfolio with very little overhead and G&A. So that's the royalty and streaming model, and we're thrilled to be applying it in the uranium space, which has never looked better.
Great stuff, Scott. Thanks again for your time today.
Thank you. Take care. Bye.
Hey everybody, Gerardo Del Real here. If you're enjoying the content that you just saw, you can let us know in 3 simple steps. Hit the like button, hit the subscribe button, and please share across your network and on social media. Take care, everybody.